Hey everyone, welcome to the webinar. We're going to get started here right away. So find the chat box, find the Q&A. That's how you can communicate with us throughout today's call. We have a star-studded lineup of experts here. Of course, Barry Habib, Julio Gonzalez with Engineer Tax Services, Greg Kammerer, Engineer Tax Advisory, Nick Castellino, Mint Air, and Steve Blumenthal, Capital Management Group, Inc. So we're so excited to have you all here, and thanks, gents, for joining us.
Well, this is great that we're together today. We've been talking about this webinar, and I'm very happy to do this. Look, I know that this has been a challenging time for you guys, no doubt about it. And when I started to hear many of you talk about the struggles that some of you and many of you are experiencing, and a lot of this is mental too, because we've been on the precipice of interest rates getting better, only to have events change course, and then we see interest rates get a lot worse. And I understand for many of you, refinances have slowed, but also purchases have been a little bit more challenging as well, especially in the last month. So we thought it might be a good idea to take a look at some blue ocean strategies. And much like the Peter Lynch philosophy of investing, one of my favorite investors, uh, wanted to see what we know works, what we're doing, and what is working, and be able to present that to you in a way that you can hopefully capitalize on it. So, we're going to talk about today are ways for you to be able to find some new referral sources, whether it be someone who is a financial planner, an accountant, a family office. We want to make sure we cover this and give you enough so that you could go to them with these ideas. So there's everybody's interested in reducing taxes, right? That's the biggest thing. And um, I want Greg to kind of go over this a little bit more in detail on how it steals from the wealth creation generationally, and how mitigating taxes can make an incredible benefit and difference for generationally on your families. But what we also want to do is show you how you can approach accountants, and instead of saying, hey, you know, I'm really nice, send me a loan, let me help your clients, ways that they may not have had um, thought about to mitigate taxes for their customers. And there's a little background noise I'm picking up there. So if I don't know if you guys want to mute, if you've got some background noise behind you. So that'd be great. Um, Ways that they can really help their clients. Accountants tend to be historians, where they take their clients' information and they look at the past year's tax return. They say, okay, well, did you get the K-1 from so and so? Did you get the 1099 from so and so? And just kind of do it in a historian manner. And they don't oftentimes think out of the box, and especially because they might be under a time crunch. So what we want to try and do is help them help their clients in a way that can be very fruitful for their clients, make them more valuable, but also for financial planners, giving financial planners a way that they can also add another service to their customers that make them more valuable. Family offices constantly looking for resources and ways to drive this. So what we did was we tried to amass a group of individuals today that will be able to help you and benefit you, and we'll go around. But I just wanted to kind of chat with you as to what we're trying to do here. Now, the big tie-in for you is obviously getting your foot in the door and getting referrals. But hey, if there are clients, and we'll go deeper on this, that could benefit from some of these strategies, but they need to tap into some of the dollars in order to do so, well, what better way than to have you be able to access the funds that are trapped in their home? People have all kinds of equity in their home. And the best part about these strategies is that saves so much in taxes that it is a very low sensitivity to interest rates. They don't care if the interest rates are 1 or 2% difference if they're saving literally hundreds of thousands of dollars. So that's kind of the level set to get started here. Uh, Julio Gonzalez, you've seen him before on on other webinars that we've done. Julio is someone very influential. He is one of the architects of the One Big Beautiful Bill Act that has really changed things around. We wanted to make sure that everything we do is done perfectly and correctly. So we wanted to bring one of the best legal minds and resources in tax planning to make sure the things that you are going to be explaining are 100% correct. And Greg Kammerer is here with us today to do that. And then uh, Steve Blumenthal, who you probably know from John Malden. Steve has his own On My Radar, which is great reading. You should all do that. It comes out every Friday. Steve is a brilliant, brilliant financial planner and asset manager. And what Steve is going to do is he's going to kind of bring this forward to you as in a way that where he's helped individuals with different types of tax mitigation strategies and what's been most successful. And then one of the ways that we're going to talk to you about that's very innovative that has only really come about in practicality as probably the best resource since the One Big Beautiful Bill is aviation. So I wanted to bring Nick Castellino, who I know for many years. Nick has developed a incredible strategy to help people. He manages over 110 aircrafts. I think he's up to 114 aircrafts under management for Nick. So that's our group today. And where I want to get started is Julio, what's the reason why you got together with people to bring forward this One Big Beautiful Bill Act?
The best thing about it, we got bonus depreciation back 100%, and it's permanent. Barry, that's huge, right? And that is so beneficial because when people are buying equipment or buying assets, now we can take the full deduction. The IRS used to make us wait 5 years to buy something and write it off over 5 years. This is a big benefit, Barry. And I think about it because listen to this. My clients, we got to get the double hitter, right? What I'm talking about is okay, so you know what I've been seeing, Barry, is a lot of my clients that have real estate are buying jets, right? Because Barry, you can buy a jet and write the whole thing off. And I'll give you an example, Barry. Do a $5 million jet, but you're only going to put down $1 million, right? But you're going to get a $5 million deduction that year. Now, my clients, where did they come up with that $1 million? They're going to get a tax benefit for taking a loan out on their property. Right now, they have $1 million of equity in one of their properties. They borrow that. And like you said, Barry, the interest rates don't matter. Now we're going to get a $5 million jet write off using $1 million on an equity line on our home, mortgage, second term mortgage, whatever it is. And then we're going to get some tax deductions from that. Like
So if I
what better way to get some tax benefits, Barry?
So thank you, Julio. And I would imagine the reason why you guys came up with the One Big Beautiful Bill is because you want to spur activity on big ticket items because that's what's going to generate GDP. Am I right? It's gonna crank up GDP. I mean, obviously, if you give a benefit on an appliance, that's one thing, but you know, $1,000 appliance as opposed to $5 or $10 million aircraft, that's what's really going to spark GDP growth. Is that right, Julio?
Sure. I mean, it's been night and day, Barry. I've been running this tax practice for 25 years, and for the last 3 and 4 years, we didn't see that activity because we didn't have bonus depreciation. It greatly picked up when people know that they can invest in their businesses, in themselves, and get a tax benefit, not have to wait and not have to delay that tax benefit. It's been significant. It's been significant. And I think the best way is if you have equity in your properties, one of your properties, or you have a property that's free of debt, go borrow against it because Barry, now you're getting a better rate than you would get anywhere else on property, right? And you're utilizing that cash to go buy a jet, some equipment, invest in your business, and get substantial write-offs. Like I said, 5 to 1 in my instance. Million gets 5 million, and I'm taking that million and I'm getting tax benefits from borrowing it from my property.
Okay, so and I'm already seeing in the chat, guys, $5 million aircraft. He's dead on. We'll explain everything to you. Let's make sure you just listen to everything because I think you'll be well educated. Uh, but on a $5 million aircraft, let's review that. So if you purchase an aircraft for 5 million, let's say there's 400,000 in closing costs, but you take out a $4 million loan, which we've seen happen over and over again. So you put about $1.4 million into it. But depending on the state you live in, these are typical upper incomers. So you could be in a 40, 45, 50% overall tax bracket. So just to use round numbers, $5 million aircraft, bonus depreciation. And Greg, bonus depreciation means you take the entire amount of depreciation as a write-off immediately, right? Same year, right? So you could do that. So uh, That
Correct.
$5 million aircraft, you save $2.5 million in taxes. You use 1.4 of that to purchase the asset. You have $1.1 million. You're already profitable ahead of time. Is that right, Greg?
Yeah, I mean, listen, there are nuances to everything, but in generally speaking, when you're dealing with these clients who can afford, they're generally business owners or they have large, business assets. This is not typically somebody who's a teacher making $125,000 a year, right? So I think we need to keep that in context too. But yeah, 100%.
And then, Steve, the way that you're putting this together for your clients is in a way that, as Greg says, these are upper incomers, right? But think about this from a loan officer's perspective approaching you. If you had a loan officer approaching you and their clients are looking to mitigate taxes, uh, walk us through how you would work with a loan officer so that you can help them with this concept.
Wow, thanks, and great to be on here. I like the idea that Julio had thrown out there in talking about utilizing real estate as a leverage point to borrow from to put a down payment. If you think about the $5 million, and if you're the 40% tax bracket, you buy a plane, you get a $2 million tax credit right out of the gate, and you're putting up roughly 1.5 million to buy the aircraft. How are you financing that? Where are there specialists that will help loan against that in the aircraft lending business? I really like the creative idea of home equity. If that's a possibility, I think that makes a lot of sense too.
And the way you're doing this with some clients of yours, I know because in the past couple of months, how many of you put together on these types of aircraft purchases?
We've done five.
5 so far.
Hmm.
And some of them, I think you were telling me in the pre-call, were some were individuals who had a very big appetite, but many of the clients that you work with don't have either that big of a tax shelter need or that big of a pocket that they can go ahead and spend that much. But you've put together groups. I think one you told me was 8 individuals, one is 5 or 6 individuals. Tell us a little bit about the structure, because if people listening to this say, "Oh, I don't have somebody who needs a $5 million write-off," but what if they need a $400,000 write-off because they're making that much in income and they don't want to pay taxes on it? Tell us how you walk that through.
Yeah, so a couple of things to throw out. If you are an ultra high net worth person, then putting a million, million and a half down, we think of it in terms of what's your exposure risk compared to everything else you have. So you want to make sure that you're sizing your bets the right way. So we look at that first. So for some people, um, coming up with $1.5 million from $1 million to put down is a big stretch. So what we did was we created for our clients two different LLCs. So one has, I think, 6 members in it. The other one has maybe 8. And one of the LLCs is taking the lease option, which I won't get
We'll
ahead
we'll
of you,
we'll get
Barry,
we'll
here.
get into
Yeah.
that. Yes.
So we packaged a LLC structure for investors for smaller amounts to be able to come in. Let's call it $200,000. I think we have a couple people that put 100,000 in. We have people that put 500 in. So the LLC creates the vehicle to be able to buy one aircraft, and the members own a share in the aircraft.
So let's just walk that through for a minute. Let's just say the cash that you had to raise is, let's just say, $1.4 million to pick just a round number. So if you
Hmm.
put $200,000 in, you own 14%, 1/7, 14.2% of the LLC. So on
Right.
a $5 million aircraft, you would get 14% of that, or a $700,000 tax shelter that you could take immediately. Am I doing that right,
Correct.
Steve and Greg?
Yeah.
Is that where you be? Which, look, obviously, if the person's making 3 or 4 or 500,000 dollars a year, or if they've got capital gains, this could be an enormous benefit for them.
Well, I'm personally involved with one of the LLCs as an investor in the LLC, and I'm looking for a 4x type of offset against my income.
Yeah.
That's the
I think the
basis. So
big
three, so take 300 times 4. I'm offsetting 1.2 million in taxes.
I think the
Greg, you
big
agree?
thing, like for Steven's like point where he's getting at is, everybody who's like listening to this, you want to think about your assets, holistically or globally, and what assets can you borrow against, right? I mean, obviously, with the clientele here, we're talking about taking money out of the home. It's no different than if you were to get a loan against your stock portfolio or any collateral that you have, right? And then using that free liquidity that you may not have, and then buying assets that are subject to 100% bonus depreciation under the new bill that Coolio helped co-author. It doesn't have to be much more complicated than that from the legal perspective. It's understanding, the compliance around that, which can be tricky and nuanced. But, what Steve's talking about is you can get a very powerful leverage point for if you do have a client who's making a couple $1 million a year or even a couple $100,000 a year, you do have the ability within the rules and regs for creativity to zero that out appropriately.
All right, so Nick, let's tie this together here because I see there's questions, and obviously you should have these questions. So the first question is we know when you think about airplanes, you might be thinking about a new airplane for 25 million or 30 million dollars. So Nick, you've placed over 100 of these. Why are you looking at aircrafts in that? And I know we've talked about this $5 or $6 million range. Why are you looking at that?
So it's very important. I saw a few messages in the group chat that airplanes wouldn't be priced in that $5 million range, which in most cases is true, but we're not buying brand new aircraft. We're buying $4 to $6 million airplanes that have already hit the backside of that bell curve and have flatlined in depreciation, which is a vital part of the business model.
And then those aircrafts, I mean, you're looking at 20, 25-year-old aircrafts. How do they perform?
They perform very well. That's also another part of the cash flow aspect of this investment. They fly between 70 and 90 hours a month.
And then based upon that, and obviously we know that the FAA has very strict maintenance requirements. Could you speak to that for a minute?
Yeah, so part of the acquisition process is really doing a thorough pre-purchase inspection, as many people would do on a real estate purchase, but it's a number of things. It's reviewing all of the maintenance records since the aircraft's manufacturing date. It's going through what is referred to as a CMP run, which is basically a large document that forecasts all upcoming maintenance and everything that has already been done. But we think about this from a very institutional investment standpoint in 5-year cycles. So we want to be sure that the aircraft we do purchase over the next 5 years does not have any scheduled maintenance that's going to be a large expense.
Okay, so let's just walk this through. So someone purchases a $5 million aircraft. They put up $1 million for the down payment, 400,000 for closing costs. They borrow $4 million. They've done great up front because they've saved all this tax money, so they're doing great. But now they have this asset, right? And as Steve was alluding to, you could do this one of two ways. You could take that aircraft and lease it, or you could charter it. Could you walk us through the lease option first? Because that's something that is very appealing to many people.
It is very appealing, and I'm glad you bring that up, Barry, because of our 119 aircraft, 72% of them are on a triple net type lease structure. So there's two things that you guys have probably heard here. One is the lease option. The other is a revenue share, or often referred to as charter. So the dry lease option is fairly simple, right? It's a publicly traded backed company. Let's take a $5 million aircraft, for example. So 115 to 120 basis points of the aircraft value will be paid per month, and all expenses are paid by the lessee. So it's purely basically a risk-free return with your initial investment in financing the aircraft.
So these come out to where you can get pretty much a risk-free. I mean, look, everything has risks, right? Because even though it's a publicly traded company, the counterparty, is it possible that that go out of business? Yes. So your return's not necessarily 100% without risk, but it's pretty risk mitigated. And obviously you
And
only
Barry,
have.
just one important point on that. Don't forget the LLC is owned and controlled by the investor, right? So you have the asset to back your investment as well.
All right. So in other words, if the counterparty doesn't pay, you take the plane, you go elsewhere.
You kick the tenant out of the house and you lease it with somebody else.
Got it. Got it. So in this particular case, guys, if we were to do a lease option, how long are those leases typically in place for? And then let's walk this all the way through. What happens after the lease, or what happens when you want to sell that asset?
Right. So to your first question, leases are typically structured 3 to 5 years. And then after that 3 to 5 year period, you have a couple of options to consider. These aircraft will have a lot of useful life left after the lease term based on how we buy them and what I alluded to with our maintenance review earlier. So a couple of things can happen. You could either release the airplane, you could reposition the asset, meaning sell, depending on what your tax situation is at that time. I saw recapture a few times in the chat, and that is true, but very similar to a 1031 exchange on real estate, purchasing another aircraft will offset that recapture that you deal with.
All right.
Or the other thing, if you don't release the aircraft, you can put it on what's called a revenue share program, which Barry will get into.
Okay. So in this case, you're going to be leasing it to you own the plane, you lease it to a publicly traded aviation organization, so very little risk. Nothing's 100%, but very little risk. You still have the asset. You keep it for a period of time, 5 years. You maybe renew it. But when it comes time to sell, now I've taken that plane, I bought it, whether it's a share of it or the whole thing, and I've essentially depreciated it down to zero, right? Greg, how do you avoid paying tax on that recapture? Because then whatever you sell it for, and we'll get into the values of that, whatever you sell it for, how do I avoid paying tax on that?
I mean, it's really through the correct legal structure. I mean, when Nick was talking about it, there are similar situations where you have like a 1031 for aircrafts that, happy to walk people through. But again, everything kind of comes down to timing and the right form over substance to kind of get through those types of strategies.
So if you purchase another aircraft, you can avoid paying the tax similar to a 1031 exchange, is the bottom line.
That's the bottom line.
But what you have to understand, and everybody, I want to make sure you go into this eyes wide open, is this is something that if you want to forever avoid that tax, you have to keep rolling this over into a new asset and until your demise, right? And then Steve, what happens at that point in time? Do you avoid the tax altogether?
Well, then you get a stepped up cost basis at the time of your death. So at that point, yes, you no longer have the tax.
Okay. All right. So this is very, very important and very interesting. And Julio, we know that if you were to take the first direction that we're going, it's a lease, right? And that lease will, and correct me if I'm wrong, Julio, protect you from any income that the aircraft generates would be protected by the depreciation and any passive income like K1 income. Is that correct?
That's correct. So great tax benefit for the investors. And I think a great strategy, Barry, overall for someone that's looking to offset taxes during the year. We get a lot of clients, Barry, that know they're going to have 2 to 3 million to 4 million to 5 million in taxes. And they're but we have a year end that they have to do something by, right? And Barry, the mistake I see with a lot of clients is they wait too late. Barry, they already know the tax liability is coming because they've sold the company, they sold the property, they know they have a big tax consequence. So Barry, I think getting into the strategy now versus end of year is super important.
All right. So let me ask this. And look, the reason why we're explaining this to you is so you can actually go through some of this with your clients and who need the ability to shelter taxes, and you can help them pull out cash out of their home to do this, but also so you have something to go to an accountant with or a financial planner with. Um, Correct me if I'm wrong, guys, but Nick and Steve and Greg and Julio, it doesn't appear that many accountants or even financial planners are familiar with this strategy because it's so new. Is that correct?
Oh, I totally agree with
Correct.
you.
I would add to that I moderated a panel for family offices earlier this morning with another great tax attorney and a family office formation expert, and they said that outside of the OZ funds that are coming up and some stuff that's going on with the data centers for depreciation, aircrafts were one of the number one tools that family offices and medium-sized business owners were using. To your point that we're making, you need to make sure everything's done correctly, but it's something that just consistently gets overlooked. And because of what they can write off year one, has been a very effective planning tool.
All right. So look, guys, we're bringing this to you because if you're saying, look, I'm slow on my originations, I'm looking for another avenue, approaching accountants, approaching financial planners, approaching family offices with a nuanced way of helping their customers that also not only gets you an in with them for their referrals, but also potentially allows you to refinance some of their clients to pull cash out so you can help them. I'm not just talking about your clients. I'm talking about an accountant who has a book of business. They've got people facing large tax liabilities. How are they going to make this investment work? Well, maybe they have to come back to you to pull some cash out of their home. So these things are working for people. It is working for the individuals. But now we talked about passive income. We talked about income that's generated from the aircraft. Last thing to talk about aircrafts, and then I want to get into some other tax saving strategies too.
Hey, Barry, can I interrupt for 1 second?
Yeah, please.
It's a good point to say on that. So we work with ultra high net worth families, and when we have these discussions with them, of course, it pulls in their CPA, and we have those discussions then with their CPA, and the lights just go on. So what you're, not to understate how important it is and that value is by bringing the idea. So we see that in every one of those calls.
Yeah, I think you guys will find that this is something that's very, very, very interesting. And it will ignite a lot of discussion with those accountants. So what about, just to cover that, just to tie a loop around this whole thing, two pieces. One is, first, let's stay on the tax piece. What if I sold the company, or what if I have a big gain? There's an IPO that did exceptionally well. And maybe I was a very early investor in SpaceX, and now I've got a few $100,000 or $1 million in capital gain. Or what if I have W-2 income and I'd like to shelter that W-2 income? Can I use this aircraft strategy? Who would like to take that one?
Yeah, I think. Okay, go.
I'll jump in and say that the tax side of it is incredibly attractive. But the income side of it is also attractive. We look at a lot of different types of tax mitigation strategies. We have a paper that we wrote about tax mitigation strategies, and it is looking at both sides of it really is the way to look at it. The tax value of it is important, but you do it from an income standpoint as well.
Got it. And Nick, what do you have to do to alleviate ordinary income, capital gains, dividends, interest income? What do you have to do there?
So you have to show active participation, Barry.
And active participation out of Greg or Nick, you want to tackle that one?
Yeah,
Yeah,
I mean,
absolutely.
again,
Go ahead, Greg.
go for it, Nick. I would just, general, there's a couple ways that you materially have to participate, Nick, on the AV, and it's no different than if you're using that if we have a bunch of mortgage professionals here, it's like a rep status. There's obviously several rules that need to get followed on the aviation side. So Nick, if you wanted to maybe kind of just high level give a couple of those.
Yeah, so with regard to active participation, you have to show a certain amount of time that you're actively involved in managing the process of the airplane. So that could mean a few things, right? It could be the logistical management of the aircraft, it can be marketing, it could be a number of things, but permitted you show that active participation, you can use this against ordinary income.
All right. So let me just ask you if I've got this down, so you could correct me if I'm wrong, because this is what my research has found, and the way I'm doing it with mine is, if you show 500 hours over a 1 year period, right? You don't have to continuously do it. That would suffice. Similar to real estate, because many people here are familiar with cost segregation on real estate, but that's 750 hours participation. Aviation, 500 hours for the 1 year. Is that what am I repeating that correctly, Julio and Greg?
You're spot on.
Yeah, spot on.
Okay.
And that, Barry, that's easy to do because with the companies, they're sending you daily reports, and you're going through those reports, you're managing your jet, you're seeing where it's chartering, you're reviewing the financials. So it's easy to do once you start going through the reports, if that's your purpose, right? If you want to be active, there's a tool to do it, and there's daily reports to help you get there.
And I
So
also break it apart too. Like when you think about it, when some people are like, oh, like that's a lot to do. I mean, if you generally think a general work calendar is 2,000 hours a year, that's your typical 9 to 5, Monday through Friday. If you're somebody who's really trying to leverage this, doing 500 hours during your own time with also the benefit of weekends, you can do more. So I think just to say use that as a stepping block where that doesn't, that's going to preclude you. Uh, you're not thinking about this the right way in terms of being creative and how you can use the rules to your advantage.
well, if it's going to save you several $100,000 in tax, you'll find a way to do it. Just to be clear, you can take passive income, K1 income, and the income that the aircraft generates, and you do not have to do that active participation. It's only if you want to use the bonus depreciation against your similar to a a cost segregation on real estate. It's 500 hours for a period of 1 year, and then you could use it against ordinary income, capital gains, W-2 income, dividends, interest. It really becomes a wonderful, wonderful shelter and a wonderful strategy for. And Julio, taking a look, speaking of cost segregation, I think it's great, and I know you're a master at that. But real estate doesn't get you there the same way. Is that correct?
It doesn't, real estate is a gift. The fact that the IRS allows us to take cost segregation, which is breaking up the building into components, Barry, and appreciating the building, not as a building, but as flooring, as lighting, as HVAC systems. And when you do that, Barry, that means that typically 25 to 30% of the building can be written off in the first year. So it's a great benefit. Real estate's one of those benefits where the IRS says, if you invest in real estate, we're going to give you the benefit of being able to expense it. Typically, you're expensing it over 30 to 40 years, but with the cost segregation state, you can accelerate maybe 25 to 30% of it. But it's not like a jet where you get 100%.
Understood. Understood. And Nick, last piece on the jet is there is people who like to fly private or that would like to do that. Is there a benefit if you own the plane where that could come into play?
There sure is, and that's one of the fun things because a lot of people that purchase these aircraft are in a very good place and they view them as toys. So personal usage becomes a high point of focus, and the benefit to that is you're paying direct operating costs of the usage of the airplane versus if you were to charter, basically rent the plane from a company, you're paying about double what the direct operating cost is. So that's a good benefit.
But
And
to be
flying
clear,
private is better than commercial.
yeah, but to be clear, just so everybody knows, it's not free, even if it's your own plane, and it's still very expensive. Am I right?
You're absolutely correct. It is absolutely not free, and it's costly.
Okay. So, Steve,
Barry, 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 I would say one thing real quick though. It's costly, but you can, that cost is absorbed by 8 to 9 people on the jet. Right?
yes.
So, it's not you just buying a ticket first class and going somewhere, right? You're putting 9 people on your jet first class. So, if it's under your own costs, it's pretty efficient.
Yes.
I'd say
Yes.
the other thing to point out here is that you're typically not going to be flying your own plane. You're in a pool. You're kind of like in a club here, whether you have the leasing relationship or you've got the charter. So you want your plane flying and the charter company putting butts in your seats so you make some income.
So, just to explain that a little further, I think what you're saying here is that because you have your plane with either a lease or a charter company, that then gives you the right to have access to their fleet at a deep discount, and you could pick the plane that suits your mission best. Is that right?
Thank you. Thank you. Yes.
Okay. All right. So Steve, can you help us because Julio mentioned cost segregation, which is great, and real estate is great, no question about it. This is what we eat, sleep, and breathe. You have a great expertise in some other areas of saving money from taxes too. I know we kind of spent the first 20 minutes on aircraft, but what's some other areas that we can both save our clients money, but introduce these tools to referral sources so that we can gain more referral sources?
Well, I'll give you a couple ideas. One is the oil and gas area. Uh, in our tax code for over 100 years, has been the incentive to drill and create energy. So you've got to be careful in what you're looking at. Again, back to sizing things in the right way. But if you invest in a really strong operating group in oil and gas, put 100,000 in, you've got roughly a 75% deduction against any kind of income in year one and another 25% in year two. So it's a great offset. A lot of our advisors will help clients think about IRA to Roth conversions. So it's a nice tool to be able to move money as effectively as possible from IRA into a Roth, which is a better vehicle tax efficiency wise, and offset the tax that that conversion creates by investing in either something like airplanes or oil and gas or both. So it's another really good tool that we utilize. There's a program called Vintage Photos. This is a little bit in a different direction. Think of it like a charitable contribution. So you're buying a collection of and then gifting to a charity for roughly a 4x type of write-off. It's subject to 30% max of your adjusted gross income, just like any charitable contribution would be. But it's a reasonable tool, again, to help mitigate taxes.
Yeah.
There's car washes,
Wait, Steve,
accelerated.
I want to just go back to that because that's important because we've talked about this in the past with you guys that there are some great tools that you could do where, if it's just highest and best use or it's charitable, where you get that multiple, like you said, 4 to 1, but there's a limitation to how much you can get as a benefit, 30% of your W-2 income, right? That's basically it, or adjusted gross income.
Correct. 30% is
Okay.
the role. So let's say you put 100,000 in, you get $400,000 a tax deduction. Well, you're going to need roughly 1.7 million in income to take that 400,000 deduction, take a 30% of your 1.7 million income, and so you're capped at how much you're going to see you work backwards. But if you play the math out a little bit further, you put 100,000 in, and then you've gifted this to charity, but on that 400,000 on that income, that 400,000, you would have paid, if you're in the 50% tax bracket, it would have cost you would have paid 200,000 in taxes anyway, and you put 100,000 in to save 100,000 in taxes. So it's valuable. So that's a
Very.
tool.
And I've seen people. I was just glancing at some of the comments. People are saying like this aircraft strategy. Could you put it towards, I think somebody said the dump truck or something like that, or whatever it is. The difference is here a truck to move RV Rentals LLC. Can I use the strategy? The difference is that the aircraft generates you income, and if it's a lease, it's actually where it is as close to guaranteed as possible. And if it's a charter, while it's not guaranteed, the upside revenue is pretty significant. Steve, what has been your experience with that? Or Nick, what is your experience on the revenue percentage on charter that you could be conservative and estimate that you can gain?
Yeah, so conservatively, it's in the 13 to 14% return versus a lease is closer to 11 or 12. So with that upside and charter risk, there's a little bit of a higher return.
Okay. Okay. And Steve, is that also, what have your charter returns have been?
So that's consistent with how we've penciled out the three planes that we purchased that are charter and the one lease. So it's in that ballpark. I think that's wild. And the lease option that we're doing, the return is set at our expected return is 14.4% for
Okay.
the
I mean,
lease.
it's pretty handsome returns, I have to say. I mean, these are reasonable returns.
Well,
Um,
Barry, I would add to that. I mean, the idea is, we're talking about tax saving strategies with also returns, right? There's plenty of things out there that you can, in theory, like truck, get the deduction, but at a certain point, why are you letting the tax, tail wag the dog, right? It's like you still want to make
Mhm.
sure that your whole plan is to keep on making money. You're just doing that as efficiently as possible. We have referrals all the time for clients who just want to save money. At a certain point, I'm like, if you just want to save the money, and not do anything productive with it, you might as well just pay the tax, right? So it does come down to the driving factor where how do you save money through elegant structures and the proper planning and the right products, but the products ultimately have to generate a commensurate risk return ratio so you feel good about going through that process.
And Steve, what other tax strategies are you employing with your clients as well at this point in time? Or Julio, jump in because you're a master at this as well. So please just jump in because I want to share with everyone tax mitigation, but I also want you to think about it from the loan officer's point of view that may be a bit nuanced that they could bring to an accountant as, hey,
Sure.
here's a strategy.
Barry, I see what we're doing with some families is finding real estate and opportunity zones where it's 100% deferral of the income tax. And Greg's worked with me on a couple of those opportunities. Greg, you want to talk about the opportunity zones and what we can do with real estate in those projects?
Yeah, I mean, so high level, if you aren't familiar with opportunity zones in the first iteration of the bill, you basically were able to take your long-term or short-term capital gains and defer that up until the end of 2026. There were some stepped up in basis, which were very nice. Also, if you held on to the capital gain portion for 10 years and you had, say, a $5 million gain on top of that, you wouldn't also get taxed on that. So very powerful. The new opportunities zone 2.0, if you will, has set up a situation amongst other benefits. You get a 5-year tax deferral, so you kind of push that back a bit, and you still have a stepped up gain to about 10% in your basis, so that helps a little bit more on the savings. And then again, if you own the asset for more than 10 years over longer term holds, you can potentially take a $10 million deferral and make it into 30 and you won't pay $20 million on that net gain on that 20 million. Also, there are situations where you can lose a private equity play as well, start a new business. Depending if you are the right opportunities, you can have a 4 or 5x if it's a truly lucrative business. And again, take a small gain and defer that and then grow that into a very lucrative tax-free position. So we love working with entrepreneurs in situations like that and help them think differently. Again, the tax code is set up that Julio helps structure to foster, economic growth and reinvestment to make sure that these communities that have been underserved are getting the right economic stimulus. And as investors and business owners, you're getting handsomely rewarded for that.
And Steve, you started talking about car washes as well before I went back. So please finish your thought. I apologize.
Well, so in the same direction, accelerated depreciation on the purchase. You're buying a lot of equipment to build and do it, and some income. So in that same category, it's more 2-to-1 as opposed to 4+1 with aircraft. So honestly, I like the aircraft play better.
Got it. No,
Barry, I
Diana,
just want to say real quickly that along with the car washes, gas stations are the same thing, right? Pretty much 100% write off on the gas stations, pretty much a 2-to-1. So I just wanted to share that as well.
And I'll add this, about a decade ago, I was working internally for a family who was luxury wedding venues and car washes, and not two things you would typically pair together. And the car wash strategy was a cash income play solely to mitigate the income from the wedding venues. So it's become much more popularized over the last 10 to 15 years, but I was literally helping this particular family buy old defunct Toys R Us boxes and converting them into 50,000 square foot car washes. And it was, like manna from heaven, if you will, to help with that the bonus depreciation.
right. So team, let me just, because I'm seeing some of the chats here, the tax code, it is what it is. We just have to understand it. So whatever your bias is on what you're thinking it is, look, the reason why it is the way it is to try and generate economic activity. That's going to be big ticket items is going to move the needle the most. But again, it's not up to us to say, okay, is this a good tax code? It's not. It's up to us is how can we help our clients better? How can we help ourselves by gaining more referrals? What can we take as new ideas to bring to potential referral sources that are less interest rate sensitive? I mean, the same people that are, throwing cold water on some of the ideas, and shame on you for doing that because you're the same people that complain rates are high. What you really need to be thinking about is what can I control? What can I do? And what these guys are bringing you is gold that works whether or not you want to try and get your arms around it and try and do something with it that will make you more money and help your clients. I mean, that's what you need to be doing right now. Stop the complaints, stop the criticism, and start getting to work on making more money. I mean, that's what this is about. I want to go back to how can people benefit from this by working with you guys directly. But first, let me ask Diana: are there questions, Diana, that you see that we could try to answer from some of the folks? Because I was only looking, just glancing at some of the stuff.
Yeah, I mean, it seemed like you hit most of the answers to any of the questions I've seen. I mean, someone asked to hear a little bit more about bonus depreciation, but that was earlier on. Expected net income per month when talking about aircraft. So a couple questions that you semi-answered, but I can keep an eye out for more as we can continue.
Barry,
And
if I could add, because I see
yes,
something that kind of is popping up. I mean, so I think I mentioned, definitely these are not strategies that for people who are not making a certain amount of money, can be applicable to, right? But I think how you get into these other CPAs and attorneys that you're working with, just kind of being a value-based resource provider and be like, listen, this is what I'm talking about. This is something that we saw as help provide great taxes. Be transparent. If you're working with as a loan officer, like, you might not have the liquidity, but this is how you can free it up. They'll understand that on the mortgage refinance side, no problem. But general awareness of how these things are being applied and education, I think, is how you start to forge relationships with your referral partners and provide true value to them. And you can get into bigger clients and better status. So like that's what I've learned throughout my career.
so look, when I was a loan officer, I loved working with accountants. I loved it because I had one accountant, Dilip Patel, and this is going way back now, but in 1 year, the guy sent in referrals to me. Remember, loan sizes were less, $33 million in referrals, less interest rate sensitive, more strategy sensitive. What we want to try to do, team, is when you approach them and somebody asks the question, okay, so how do I do that? Or somebody just said, I don't have a lot of high net worth. Well, maybe the accountant does. Okay. And you don't need 400 of them. Okay. That would be nice. But one or two accountants that sends 2 or 3 transactions, heck, that's a lot more business than zero, right? So this could be very, very helpful. That's all you're looking for. And what a great way to get in with them to say, hey, what we're able to do is help clients. Maybe some of your clients have a big issue with taxes that they need mitigated. I'm working with a group of experts that can help them. And one of the areas that I potentially can be helpful with is introducing you to people who have aviation as a great tool where they can save money on taxes, dramatically save money, use the one big beautiful bill to their advantage. And if they need financing to do this, I can provide that financing for them. And that really helps if you're working with a financial planner who's got assets under management and they don't want to take the assets under management out. Well, don't use the assets under management. You go take the money out of their home. So you provide a really good service and just getting the conversation going. Now, I know some of you are saying, okay, we've been on this call for 40 minutes. I don't really feel comfortable talking about that with an accountant from the get-go. I need to get more information. So if you need somebody like Julio or Greg on the legal side, if you need somebody like Steve to say, hey, somebody asked, what's the minimum investment? What's been the minimum investment with you to get into one of the LLCs, Steve?
We had somebody come in for 100.
Okay. So that's your answer to that. So, this is not just for the ultra high net worth individuals. These are for people who've got real tax bites. I mean, you know what? Some of you guys, if you're having a good year and past good years, I'm sure you paid a lot of taxes to where you were pissed off that you had to pay all this freaking money in tax because that's done. That's gone, right? What could you have done with that money if you could have sheltered it? And not only that, use that money to generate revenue for yourself as a beneficial investment. This is very helpful. So, Diana, could you create a way if people like Nick, you're going to be very integral in this because people are going to want to know some of the intricacies on how to go about doing this. If we could share contacts, Diana, with everybody on this call so that these individuals can be of help to you guys. That's what they wanted to do. They wanted to volunteer and be of help to you. And look, if they wind up getting business from it, God bless them, right? That's a good thing. But they're here mostly to just share information and be a resource to you to help you. It's something different. You don't want to do it, don't do it. But what does it hurt to try and get more information, be wiser, broaden your horizons? And look, if you're going to save a client let's take a real example. let's just say it's somebody who puts in $300,000. And Steve, you said 4-to-1 protection?
Yes.
That's a $1.2 million tax benefit that they receive, a tax shelter for $1.2 million. And Steve, you can roll that over into the next years, right, Greg? Julio,
Correct.
you
Yep.
could. Okay. So that's going to save them. Let's just say they're in the 40% tax bracket, right? So correct my math if I'm wrong here, but that's $480,000 that they would have, instead of paying tax over the next few years or this year, that they avoid paying taxes on. That's an awful lot of money. Do you think they really care if the interest rate is 2% higher? 2%, okay? Forget an eighth or a quarter that you fight over, right? 2% on $100,000, that's about $140 a month. So if it's on a $300,000 investment, $500 a month, okay, $420 a month. You think they care about $5,000 a year when they've saved $480,000 in tax? This is what I'm trying to get you to see. Okay, it's not
Barry,
about
can
the
I jump
eights
in?
that you're fighting. Yeah, please.
All right. So just as an example, client of mine for a lot of years, 20 million net worth, called me up and said, "Hey, I've talked to my CPA about this, and he's interested in talking to you." We had several conversations, brought Barry and Nick on those calls and explained the program. And his interest is, and what he's come back to us with, I have 4 clients so far, another who's a Uber net worth guy that may be interested in an airplane himself. And the way that he sees this for his practice is being able to bring value to his client. So you're introducing an idea that to a lot of CPAs is relatively new thinking. What this CPA is going to do is he's going to create a series of LLCs for his clients. And then he's going to be the accountant on the entity on the LLC. To me, the takeaway is how valuable it is to his practice, what he's bringing to his clients in that growth. So don't underestimate that relationship with CPAs you have in bringing this
Yeah,
sort of
everybody's
idea.
looking to make new money, right? And it's a revenue generating opportunity for them for doing the work that they're generally paid to do. And that usually helps.
It
And
does.
it's providing real
Also,
value.
and I want to answer this because people, I've seen it come up twice just glancing at it, is Roth conversions. Right now, a lot of people, they're at the age where they either have to start drawing money out of a regular IRA, they want to convert it to a Roth. Well, that's a big taxable event. Your clients might have a lot of money in their IRA that's trapped. Every dollar they take out of a regular IRA or rollover IRA, that's taxed, right? So this strategy will prevent or protect them. Accountants have this. All you have to do, and Steve kind of just wanted some of our take on this thing. So when I listened in on these conversations, the accountants light up. Okay, this is like wow. So before I brought this to you, I think all you have to do is talk to 1 or 2 accountants and see how they say, "Oh my gosh, this is a great strategy." Now they're going to have questions, of course, and that's what Greg and Julio and Nick and Steve are there for. But this is something that I think if you just would listen to the accountant's reaction, they're going to think of lots of clients that this could help, and hopefully those will be referrals for you. All right, Diane, any other questions that we have on this?
I mean, one that I can answer very easily is yes, we'll send you the recording. And as Barry mentioned, we'll send you the contact for each of the gents on the call so you can reach out with more questions. But somebody asked again what the stock ticker was for that publicly traded company you guys mentioned way earlier.
Just one of many, many, many. It would be placed with a publicly traded company. I don't know, Nick. Did you have a particular one, or there's many publicly traded companies that?
There's multiple. I mean, in our pool of leased airplanes, we have 15 different operators.
Okay, so it's multiple, but it would be backed by a very strong counterparty to mitigate counterparty risk. Somebody saying I have a client worth 1.3 million in traditional IRA. Would a plain LLC allow them? Yes, you can take that 1.3 million and instead of paying taxes on it to go into a Roth, you could shelter that. Absolutely, you could do that by using the exact strategy they talked about. You guys are going to have clients that fit into this. Who knows? Maybe some of you might fit into this, but certainly financial planners and accountants and family offices are going to have that. Aside from aircraft, Julio, Greg, and Steve, I want to ask you, what would be, so we have a good takeaway here, to round this out, what are your next favorite, your second or third favorite tax mitigation strategies?
Well, I'll jump in. Oil and gas. we're bullish on the area for fundamentally, whether we're right on our view or not, is to be determined. But we just think that the energy needs here and the build out that we're going, we're just so undersupplied. So domestic oil and gas in things that are not speculating on whether they're going to find, but are existing producing operating firms.
Steve, are you subject on the oil and gas to a limitation against 30% of your income, like
No, no,
you were not? So
no.
that's a big one then.
Mhm. Yes.
Okay. So that's huge. Julio, favorite of yours besides oil and gas and besides aircraft?
Yeah, the favorite for mine has been the real estate inside an opportunity zone.
Mhm.
Kind of the best of both worlds. You get some write-offs of depreciation from cost segregation and the deferral on the gains. So we like that one as well.
Um, and I also wanted to ask Julio, you've mentioned in the past tax credits. Can you just take a moment to talk about tax credits and how purchasing tax credits could be helpful?
Yeah, Barry, thanks for bringing that up. We have tax credits in the energy sector, and it's just a market, Barry. So some people can buy them for 80 cents on the dollar. So you're basically buying a dollar of taxes down for 80 cents. You have film tax credits, which being in the movies, and also music tax credits. So entertainment tax credits, energy tax credits. There's quite a few tax credits out there. And really, you're just buying them at a discount. Someone has a credit and wants the cash, and so they're willing to sell that at a discount, and someone would like to just pay off their taxes at discounts. So there's a good market for that.
How much of a discount can you buy those tax credits for, Julio?
Yeah, Barry, I've seen them down to like maybe 80% at the lowest. And it depends, Barry. It's kind of like when you buy a jet. Do you want to buy the jet in December when everyone is starting to think about it and the jet prices go up by $1 million for the same jet? Or do you want to, and it's the same for the credits. They go way up in November, December, but if we buy them now, we're probably down 20%. If we buy them there, maybe it's at 98%, 2% discount.
So in other words, let's just say if you buy it at the right time, Julio, if you have $100,000 tax liability, you might be able to, for $80,000, buy $100,000 tax credit to wipe that out. Am I speaking correctly here?
Correctly, yeah.
Okay.
Maybe now, Barry, but like I said, it tightens up at the
At
end
the
of the
end
year,
of the
just like,
year, yes, premium,
yeah,
premium.
premium.
Okay. Well,
Julio, is there a market or an exchange for that? How do you source that?
Yeah, not a formal market, but certainly, we get them a lot from doing the tax credits for our clients and then creating a market for them with the accounting firms and their clients.
so Nick, just to kind of make sure I try and talk to you here, because a lot of people heard a lot of things, and I want to just try and tie this up in a bow. Please tell me if I'm reiterating this correctly from what I understood, taking all this in. Let's just say you find an aircraft for a client, and I'm sure you're going to, as you said, do the institutional level of due diligence that you do to make sure that's a good aircraft. You want to buy it older so that you will get good charter revenue for a low investment. These things are going to be in good shape, and also less depreciation because they're going to depreciate much more slowly, but they are going to depreciate. However, the loan amortizes, so they kind of balance each other out as far as equity goes. Now, when you take a look at something like this, Nick, I want to just repeat this so you tell me if I'm right. Let's say you find him a $5 million jet. That jet then would be 80% financed. So you put $1 million down between hiring pilots, inspections, and acquisition fee, all of that. Let's say it's $400,000. So it's $1 million for investment for a $5 million jet. But that $5 million jet gets you, if you're in the 40% tax bracket, $2 million. So right up front, you save 2 million, you use 1.4 million to the jet, you're $600,000 profitable day one. And then that aircraft, let's say be conservative, will make you 10, 15% or more as an asset that'll make you money. Did I get that right?
Spot
Okay.
on.
All right. So if we are armed with just that, everybody, that's worth the dialogue just to introduce it to an accountant or a financial planner. And then if they want more, they come back to you guys, and all these experts here can help you get from point A to point B. Team, this has been great having you on. I hope you guys have enjoyed it. It's a different way of thinking. It's out of the box, but this is what we got to do right now, right? We got to think out of the box. I hope you guys have enjoyed it.
Well done, everyone. Thank you so much for joining. Hope you learned a lot today. I know it was a lot in a short time, so we'll send you the recording. You can rewatch. Feel free to share. And then, of course, reach out if you have any questions. But we appreciate you so much, and we'll see you
And
on
Diana, you're
next
going to
call.
give everybody Nick and Steve and Julio's
Yeah.
and Greg's information, right? So they can reach out to them directly.
Yeah, and that same email you get this afternoon with the recording, you'll have all the ways to reach out to the guys on the call.
Thanks, guys.
Amazing.
Thanks so much, everyone.
Thanks so
Thanks,
much.
everyone. Bye-bye.